Welcome to Level 3, Lesson 5. My name is RIA the Trader from TradingWing.net. In this lesson, you will learn about trend lines and the popular patterns that are found with trend lines. So let's get started. Before we begin, it is important to define what trend lines are. Trend lines are identical to horizontal SR lines, as they are also support and resistance lines. The primary difference is that trend lines are SRs that follow the particular trend instead of simply being a support or resistance. Trend lines are either angled or horizontal. Let's take a look at an example to explain how trend lines are drawn. Looking at this example, it is quite easy to see some horizontal support and resistance lines. Let's go ahead and draw our first horizontal resistance point. Now that we have the horizontal line, as you learned in the last lesson, it is now important to draw a trend line. In this particular case, it should be angled as the trend is moving upwards. As you can see, this trend line is quite reliable as it bounces off of this trend line on numerous occasions. Now you may be wondering, why is it important to draw trend lines along with horizontal support and resistance lines? This is because these trend lines can form very popular patterns that traders can easily identify. These patterns help you determine if the pattern is bullish or bearish. Here is a list of popular trend patterns: rising and falling wedges, ascending and descending triangles, bullish and bearish flags, double tops and double bottoms, head and shoulders and inverse head and shoulders, bullish and bearish pennants, symmetrical triangles, rounding bottoms, and cup and handles. Let's go ahead and break down each of these patterns. The first popular type of trend patterns are known as rising wedges and falling wedges. The rising wedge is a bearish pattern where the support and resistance begins wide and tightens as the trend continues upwards. The rising wedge typically ends with a break below the support followed by a rundown. Falling wedges, on the other hand, are bullish patterns. The support and resistance also begins wide and tightens. However, the difference is it tightens as the trend continues downwards. Falling wedges typically end with a break above resistance and follow with a run up. Let's have a look at an example. Looking at this example, it may not be clear where the trend lies, which is why it is important to continuously draw trend lines and horizontal lines. So let's start by doing that. First, I would like to draw a resistance trend line. Now that I have that, I would need to draw a support trend line. And again, now that I have that, I have identified a pattern. If I look very clearly, we can see that there is a rising wedge pattern. It begins wide and starts to tighten as it works its way upwards. This is a bearish pattern, so we are expecting the trend to be broken below the support. Let's go ahead and play out and see exactly what happens. Perfect. That played out exactly how we thought. This does not always happen, so please make sure that you are managing your risk. The next question that many traders have is, how do you know how far it will go or how far it will move down? The answer is quite simple. You look at the difference between the shortest trend line and the next trend line. In this case, we have $32. If we go ahead and place this difference exactly where the trend led to the breakdown, we can see that our target is already attained. The next popular trend patterns are known as ascending or descending triangles. Descending triangles are bearish patterns. In a descending triangle, the support line is a horizontal line, whereas the resistance line is a downwards trend line. In a descending triangle, they typically end with a break below the support, followed by a rundown. In an ascending triangle, there is a bullish pattern. Therefore, the resistance is the horizontal line, whereas the support is the upward trend line. Ascending triangles typically end with a break above resistance and follow with a run-up. Let's have a look at an example here. Looking at the example that I used at the beginning of this lesson, we can see an ascending triangle pattern. We can see that the resistance line is horizontal and the bottom support line is an upwards trend line. We are expecting a bullish movement or a move upwards following the break of the resistance point. And we can see exactly just that. But again, how do we determine the target that we will attain following the break of the resistance? Again, we look at the difference between the shorter trend line and the next. In this case, we can see 88 cents. If we add this to the resistance, we can see that our target was attained. The next popular type of trend patterns are known as bearish and bullish flags. Bearish flags are bearish patterns, as you can tell by their name. Typically, following a strong rundown, there is a slight move upwards. This move upwards forms a parallel uptrend. This is known as the bearish flag. Bear flags typically end with a break below the support of the parallel trend line and follow with a run down. Bullish flags, on the other hand, are bullish patterns. Following a strong run up, there is a slight pull down, forming a parallel downtrend. Bull flags typically end with a break above resistance of the parallel trend and follow with a run up. This may sound complicated, so let's have a look at an example. In this example, we can see a strong run-up, followed by some areas where we see slight pull-downs. Let's go ahead and use our trend line tool and find out what pattern we are forming. In this case, we see a bullish flag. Our criteria is met. We have a strong run-up, followed by a slight pull-down, forming two parallel trend lines. We can assume that we will break above that resistance line and run up, and we do exactly that. Once again, we see another pull-down. Again, the trend lines are parallel, so we can assume this is another bull flag. And again, we can assume that we will break out of the resistance and run up, and we do, again, just that. The next popular trend patterns are known as double top and double bottom. The double top pattern is known as a bearish pattern. It is identified when there are 2 points of resistance around the same price. Double tops typically end with a run down to the same level as the initial run-up. Double bottoms, on the other hand, are bullish patterns. This is when 2 points of support are around the same price. Double bottoms typically end with a run up to the same level as the initial run down. Let's have a look at an example. Looking at this example here, we can quickly identify a resistance point over here. At this resistance point, we can see 2 tops. Here's the first one, and here's the second one. After identifying this double top, we can assume a bearish pattern incoming. But how do we know how far down it will go? First, you need to identify the initial run-up point, which is right over here. And you can go ahead and assume it will come down to the same area. This does not always play out, so again, manage your risk, as it can either come down very slightly or can come down greater. The next type of popular trend pattern are known as head and shoulders, including the neckline. The name is really self-explanatory, and I will explain it in the example. Head and shoulders are bearish patterns. They also typically end with a run down to the same level as the initial run-up. Inverse head and shoulders is simply an upside down head and shoulders. This is a bullish pattern, and it typically ends with a run up to the same level as the initial run down. Let's have a look at an example. This is a great opportunity to show you that not all trend patterns look perfect. Some have flaws and inaccuracies, but the pattern is still present. Looking at this pattern here, you may not assume that you have one. However, if I break it down, you will see very clearly an inverse head and shoulders. Here is your head. Here is your shoulder. And here is your other shoulder. And here is the neckline. Here is the initial starting point. And here is where we expect our price to go to. So once you have your first shoulder, you approach the neckline. Then you build your head, approach the neckline, and build your next shoulder, and then proceed to go to the initial rundown area. If I go ahead and inverse this chart, you will see a clear head and shoulders. Initial run-up, shoulder, neckline, head, neckline, shoulder, initial run-up. The next type of trend patterns are known as bullish and bearish pennants. Bearish pennants, as the name suggests, are bearish patterns. Typically, following a strong rundown, there is consolidation, which forms a triangle pattern. This is the bearish pennant. This pennant typically ends with a break below support, followed by a rundown. A bullish pennant, as the name suggests, is a bullish pattern. Following a strong run-up, there is consolidation, which forms a triangle. This is the bullish pennant. Typically, the bullish pennant ends with a break above resistance, followed by a run-up. Let's have a look at an example. In this example, we have identified a strong pull-down, followed by some consolidation. If we go ahead and draw a trend line on both the bottom and the top, we will see a triangle. This is the pennant. Because we have seen a strong pull-down followed by a pennant, this would be the bearish pennant. Based on this fact alone, we can assume that we will break below the support and run down. And we see exactly that. The next type of trend patterns are known as symmetrical triangles. These are known as the uncertainty pattern, as they can be either bullish or bearish. In order to determine whether it is bull or bear, you must wait for the break either above the resistance or below the support. If there is a break above the resistance, the pattern is bullish. If there is a break below the support, the pattern is bearish. Let's have a look at two examples. In this example, the trend may not be prevalent, which is why it is important to continue drawing trend lines and horizontal lines. So let's start by doing that. First, we can draw our resistance trend line. Then, we can draw our support trend line. Here we have identified a symmetrical triangle, and we can tell the very clear uncertainty going on within this triangle. In order to identify whether it is bullish or bearish, we must await a break above this top line or a break below this bottom line. And finally, the last two popular trend patterns are known as rounding bottoms and cup and handles. I did not provide a description as the name is quite self-explanatory. However, I will show you examples. Let's go ahead and do that. Both cup and handles and rounding bottoms are bullish trends. In this example, we could see a clear cup and handle. If you don't see it, let's go ahead and break it down. Here is the cup, and over here is the handle. Now that the cup and handle has become more clear, how do we go about determining the target price once the handle has finished forming? What you must do is find the difference in price between the highest point in the bottom of the cup and the lip of the cup. In this particular case, it is roughly $12.60. We can now take this price difference and add it to the bottom of the handle, and our price target in this case would have been attained. Here, on the other hand, is an example of a rounding bottom. We again begin by identifying the cup. In this case, however, no handle is formed. Rather, the cup continues to run, forming a rounding bottom. But again, how do we go about identifying the price target? The same thing applies here. Find the highest point in the bottom of the cup and take it to the lip. In this case, the price difference would be roughly $8. We would then add this to the next lip of the cup, and once again, our target was attained. Some final comments. These patterns that you just learned about do not always play out. It is important to continue to manage your risk. And if your theory fails, do not force it. Don't try and make sense of it. If it has failed, it has failed. And finally, always wait for a break out of a trend or a pattern for a greater success rate. If you enter a trade prematurely, there is a higher chance your trade will fail. And that concludes this lesson.